Hey, welcome everybody. This is Kurt Frankenberg and broadcasting from the wonderful sunny state of Colorado. I'm looking outside of my window right now and seeing the majestic rise of Pikes Peak. And today I'm joined by my good friend, Mr. Good-Looking, Mike Chupka. How's it going, Mike?
Things are going pretty well today, Kurt. Of course, we're a couple days away, or I should say just one day away from expiration. So we're naturally myself and Ernie, and I'm sure you are as well, as many of our clients here and many of our attendees are analyzing their positions and evaluating what adjustments we want to make in the next, 24 hours or so.
Very good. Are you expecting a payday now?
Yeah, I mean the income method number 7 trade on Dunkin' Donuts, that short put is likely to expire worthless, or we might buy it back for 5 or 10 cents and then be able to roll to December. Let's see here. Yeah, we're using the weekly options for Johnson & Johnson now, so that actually expires on the 22nd, not on the 16th. So we're looking at that one, see how that one's going to perform. We're going to make an adjustment on our Allegheny Text, the ATI position, likely within the next, probably by noon tomorrow if we don't do it today. And I'm still evaluating a couple other positions. Some of our, I'm sorry, Kurt, some of our radioactive profit machines in the Fusion portfolio that don't have an income method open on them. We're sort of applying the 12th income method right now on some of those, which is, of course, do nothing and wait for a better opportunity. So we're watching those and looking for just a little bit better income, possibly an income method number 5 on PWR and possibly an income method number 6, I believe, on LGF and possibly even SH as well.
Very cool. Well, a lot of activity, it sounds like.
Mm-hmm.
Folks, in case what Mike and I are talking about to you sounds like gibberish, the Blueprint, the book I wrote about 10 years ago, 11 years ago, about trading the stock market with a protected position and then using income methods afterwards. That book details 11 different income methods. So when he talks about income method number 5 or income method number 6, we're talking about genuine ways to take money out of the market without necessarily selling your stock and having a protected position in place. And today we're going to actually share 2 of those income methods. We're going to share 2 riskless trades. Okay, they'll be riskless spread trades. They're riskless because of the context in which we do it, and that's kind of exciting. But what's also exciting is both of the plays that I'm going to share today leave the upside open. And that's one of the problems, Mike, that we've seen with covered calls, for example. Covered call trades, if you sell a call against your stock and you happen to be right, the stock decides to go up, and you happen to be right about buying it in the first place, you kind of limit your reward, don't you?
You have a capped upside gain when we do covered calls, and if we look at the same sort of risk-reward profile of a naked put position there, Kurt, so we end up with one of those situations where we do have a capped gain, but we're still taking on pretty much 97, 98% of the risk we would have had if we bought the stock outright.
Exactly. So what we're going to do in today's seminar, okay, today's class, this is free, okay, we're not charging for this information. We're going to be sharing an alternative, a way that you can solve the 2 biggest problems with trading covered calls. And the 2 biggest problems being, we've already identified one, that is, well, we've identified them both, I guess. One is capping our upside, and the other is the fact that we take on so much risk when we do a covered call trade. So, folks, I hope that you're as ready as I am. Here's what to expect. We're going to show how to keep your risk in your stock purchases down to 6% or less, and do it without a stop order. Stop orders are kind of finicky, and they can betray you, and they don't really provide real protection. If you set your stop too tight, for example, you might find yourself in and out of the stock with just the daily volatility. Right?
Oh, sure, sure.
And something that's even worse is if you have an overnight gap or a sudden drop like what we had in the flash crash of May 2010, where the Dow dropped 1,000 points in 15 minutes. When you have a stop order in place, Mike, that stop order does not give you the protection that you think it might.
No, it's sort of like assumed insurance, Kurt. It's if I have set a stop order at 5 or 6%, and for whatever reason we get some unexpected event. Now, we're not just talking about earnings. Of course, that can happen, and we're all familiar with that. But anything about a pre-earnings warning announcement, anything about changing members of the boardroom or boardroom scandal, a pending patent lawsuit, anything of that nature, we can wake up in the morning and see the stock down 15, 20, 25, maybe as high as 30 or 35%. Well, even with my 5% stop order, if the market opens 35% down, our stock opens 35% down, I get filled to close. But I don't get filled at 5%. I get whatever the market can get for me. So even though I had that 5% stop order in place, I'm still taking a 35% loss.
Right. So the stop loss order is not the solution if you want to have an absolute stop, if you want to make sure that you can't lose too much. But we are going to show how to keep our risk, truthfully, down to 6% or less. And then we're going to show how to take that risk and eliminate even that using one or more of 11 methods. We're going to show 2 today, which can affect what we call a bulletproof trade. That's a trade where heads you win, tails you don't lose. You know, you get to a place where you can't possibly lose anymore, but you still can continue to gain, and that's a really exciting place to be, especially with earnings announcements pending. And then, of course, we're going to show 2 riskless spread trades. That's a tall order, and we've actually been disallowed. We've been disallowed from saying this on Google. We can't say riskless spread trade. Although, if you'll check my math on it, you'll find that these 2 spread trades that we show today are going to be riskless because of the context in which we do them. So that's going to be exciting. And then, of course, we're going to give the end-of-year offer, special offer for folks that don't already have the blueprint. So, Mike, just before we get into our lesson, I'd like to know just a little bit about our audience, okay, and find out what kinds of options trading methods you're doing now. I expect that it's going to be very heavy in the covered call zone because of the title of the email that I sent out to remind folks about today's class. But I'd like to see just really what our composition of our audience is. Guys, thank you so much. Wow, the results are coming in really fast. I do appreciate that. At one moment there, the covered callers were ahead, but then folks buying long puts and folks doing spread trades kind of got close. It's kind of a dead heat right now. Okay, more than half the room has cast their vote. I'm going to leave it up there for about another 10 seconds, folks. And we'd really like to hear from you, not just for Mike's and my benefit, you know, knowing our audience, but for yours also. We'll know what to spend a lot of time on, and we'll also know what to perhaps gloss over because we're sure you already know it. Okay, so let me go ahead and close that poll and share the results. And wow, we got a tie. Look at that.
Okay, there we go. No, I'm sorry, I didn't see that actually before you hit close. It wasn't a tie, but when you hit close, but when you did, yes, we got a tie with covered calls, which makes sense based on the email you sent out, Kurt. But also we have 50% of our audience doing the vertical spreads, diagonals, condors, and possible other option combinations with spread positions.
Right. In second place, we've got folks doing long calls and puts, which is kind of a leveraged type of a play. And we do have a number of folks that either are just playing around with options, just dabbling, okay, or not trading options at all. And for those of you that are not trading options at all, we are not going to be speaking Greek to you, to make a pun. We're not going to be getting into some real deep issues with derivatives of derivatives here, okay? We're going to stick with some pretty basic concepts. But look at them in a completely different way. So I think you're going to be excited about that. And then for those of you that are very experienced, you know, the veteran spread traders, for example, I think you're going to like what we have to share with you also, because this is an application you've likely have never seen anywhere else. So we'll go ahead and hide this, Mike. And does my screen show Mr. Buffet?
Yes, sir. Actually, there we go. There you go.
There it is. All right. Warren Buffett is known as and he should be known as the greatest investor ever. Okay. Mr. Buffett is right now in the process of giving away 99% of his wealth. And you might think, well, geez, that's irresponsible. Doesn't he have a family? Well, I think his family would be okay because the 1% of his wealth left over will be over $600 million. So he's doing all right. But Warren Buffett is credited with this saying. He didn't actually say it first, okay? He was quoting a book that was written in 1970, but at a shareholders meeting for Berkshire Hathaway, Mr. Buffett said, if you've been sitting at a poker table for 15 minutes and you don't know who the patsy is, get up. Well, Mike, why should we get up at this point?
Well, because we would be the patsy. If we haven't identified the patsy at the table, Kirk, the patsy is likely us.
Right. Okay. And look, we've all played the patsy. We've all, at one point or another, been that guy. Okay. The one that has lost. Now, let's take this to Vegas. Okay. And the reason I'm doing that is because the stock market, just like gambling, just like I don't look at it as gambling, but it has some similarities, wouldn't you say, to gambling?
Well, true. I mean, we do have sort of a setup here. We've got a house, and the house has to win. Okay?
Right.
We've got players at the table. We've got experts. We've got savvy professionals. And
Right.
then we've got you and me, the patsies, or, you know, we hate to say it this way, but, you know, those that are new to the market themselves. And, you know, they're looking to make money. They've read and done a lot of education. They feel good and confident. But at the end, the market is a big, big beast, and it knows a little bit more than we do.
That's right. Now, Mike, I said you and me, and I I specifically mean you and me. If we went to Atlantic City over on your side of the U.S., okay, where my daughter's stationed on Nellis Air Force Base in Nevada, if we went over to Las Vegas, okay, you and I would not be the most savvy professionals at the blackjack table, would we?
No, not likely. I mean, we'd sit down, we'd know what we want to risk, we'd know what we'd want to play, but we're not experts, Kurt, you and I, as far as blackjack goes or poker.
Right. If you and I tried to beat the house, we'd probably end up having our butts handed to us, okay? And the thing is, options are very much the same way that there is the house, okay? The house is, well, the market makers, okay? They've got to win. They're going to win, okay? There are savvy professionals. And, Mike, I would like to say that you and I do fit into that category when it comes to options playing, okay? We have been savvy professionals. We do win some of the time. Other times we don't. But when we don't, it's a very calculated and small risk. And so we don't lose overall. We'll win sometimes. We'll lose sometimes. But we'll net win, okay? But then there are others that essentially give the profit up, and that profit goes to you and me, and it goes to the market maker, okay? And that's the patsies. Now, again, if you have not been, I'm addressing my audience right now, if you have not been winning, I'm not calling you a patsy. I'm not saying that. I'm just saying you might want to consider how much longer you'll sit at the poker table while you're continuing to lose, okay? And maybe join the side of folks that are starting to win at it, okay? All right, now, what I'd like to do, Mike, because we've got 50% of our room is doing covered calls, I'd like to address that strategy first, okay? And, you know, we've been told that we can earn 3% a month, and we can either live on it, right, every month regardless of market direction, or we can reinvest that amount to dramatically compound the value of our portfolio. Okay, now you know that this isn't something I'm making up. This is something that, as far as a claim, this isn't my claim, all right? But this claim is taken right off of the biggest website that promotes covered call trading seminars, and that'd be compoundstockearnings.com. Okay, not an endorsement. I'm not endorsing. All right, I'm just saying that this is the verbiage that's on there. They say 3 to 6% per month. So 3% a month is 40% year over year, or over a 2-year period, that'd be 100% gain, right? And then 6% per month, Mike. 6% per month, and there's 12 months in the year. That doesn't actually add up to 72%, does it, after a year's time?
No, it compounds a little bit more, so it'd actually be 100%.
Right, and the name of the site is Compound Stock Earnings. Look, if you were to do 6% per month consistently for two years, that would be a 400% return. I'm sorry, 300% return, or quadruple. Okay, it's kind of funny to realize, but 300% return means quadruple your money. That's what it really means. Okay. All right. So I'd like to do a second poll here, Mike, just for the folks that have a 24-month record or more of doing covered calls. Okay. So don't annualize your results like the gurus do. Don't say, well, you know, I made 3%, so that must be 40% this year. I made 3% last month, and I got out of the webinar, the seminar weekend last month. So I made 3%, and so that's 40% a year. No, no, no. Now I'm talking about overall, over the last 24 months. If you started with 100 grand, do you now have 200 grand that you can liquidate? That's honest math, 3% per month. Okay, and if you began 2 years ago with 100 grand, and today you have, you can liquidate your entire account for $400,000, and that's honest math, saying that, well, geez, I've gotten 6% per month. Okay, and so let's leave that poll up here, Mike, for about another 3 seconds, 2 seconds, 1 second, and close. Ooh, and it's the last minute we got even numbers. Okay, cool. So, Mike, there's 48 people in the room, okay? And out of that 48 persons, okay, we had 22% be able to vote in this, okay, because only 22% have been doing cover calls for 2 years, right?
Okay.
22% of 48 people, I'll go ahead and give you the math, but that equals 10 human beings.
Okay.
That's 10 humans. Okay, all right, so 20%, two of our humans said that they can liquidate their account for double what they started with 2 years ago. Wow, that's actually very good. Mike, do we see that often?
No, in fact, normally we don't see anyone answer that they can liquidate for double or they can liquidate for quadruple of what they had 2 years ago. So someone's doing extraordinarily well.
These two did very well, and but I'll tell you what, it's one thing to do it in the market that we've had. We have had a bull market over the last couple of years, haven't we?
Yeah, that's right. Mm-hmm.
Right. And as I say, you know, everyone's a genius in the bull market. And while that's, I'm not trying to discount what these two have done. These two have really actually done pretty well, and we shouldn't discount them. But I am going to say that I've been doing this webinar for about 6 years now. About 5 of those years with you, Mike, and we don't see that very often, particularly in a bear market when, for example, when we were doing this webinar in 2009, immediately following the crash, did we have anybody answer yes?
Well, of course not, Kurt.
Not a single human, okay, was answering that they were doing this well, okay? In fact, everybody was saying that they were losing money with the cover call trading strategy. Okay, so now 5 of the folks that answered the poll, 5 of them are ahead, but not like the gains promised, okay? 2 said they're about flat, and 1 says, hey, I lost money. I want to know why. I want to know why. Okay, well, we're going to have an explanation. We're going to also, even for the folks that did well in the last 2 years, we're going to give you an alternative that I think you'll agree will do better for you, okay? All right, so let's go ahead and get to there. Oh, by the way, I should do a broader poll for everyone now. Okay, we already found out what kinds of trading you're doing. I'd like to know, just are you happy with your trading? Are you happy with your trading? This poll's for everyone. It's not just for the folks that have been doing cover calls for 2 years or more. This is for everyone. Are you happy with your trading results? Instead of yes or no, we got kind of a spectrum here of answers. We've had another couple of folks come in the room. Welcome everybody. We're doing these polls to know a little bit about what challenges our audience is facing, and also to meet their needs exactly. Okay, so whenever you're able to participate in these polls, it's helpful not just to us, but also to you. Okay, so let me leave it up for another 5 seconds. 3, 2, 1. Folks, thanks for voting. We've got a really good turnout. I mean, a good amount if you are participating in the votes. I know that some of you can't because you're calling in rather than at your computer. But, Mike, let's talk just briefly about these results, and then we're going to show a solution. First off, we've got kind of a minority saying that they're kicking butt and taking names, but I am encouraged by how many folks are making money.
Yeah, we do have 57% of our audience that are currently making money, but they feel that they're not making enough. 7% of our audience, say they're doing extremely well. Well, we know 2 of those people were for the covered call traders that we pulled before that said they could liquidate for double. Well, that's doing extremely well, so we know they're they're a portion of that in there as well. Now, 32% of our audience have mixed emotions. They see potential. They've made returns. They've seen potential to make money. They've seen maybe other people making money, but they're just not making as much as they thought they were going to or they felt they were promised. And we do have, unfortunately, 4% of our audience that's just ready to quit just to stop the bleeding right now.
Right. With 50 people now in the room, that's 2 folks who are ready to quit. Please, guys, don't quit. Don't quit just yet, okay? All right. Now, it's interesting to see. This is actually a very high result. Usually those first 2 lines add up to about 20%. And today they add up to about 2/3 of the room, almost 2/3 of the room. 64%, 7% absolutely kicking butt and taking names. 57%, making money. Not enough, but I'm making money. So, folks, I'm going to bet that you're going to be pleased with what I have to share with you. So much that you'll put yourself in the category where, man, you're a happier trader next year, okay? And I'll defend that. So, Mike, are we back on the screen?
Yes, sir.
Okay, all right. So we've spoken about the poker table, okay? So here's another table at which you might find a patsy, okay? They say to cut losers short and let winners run. That's the advice, right? Well, we're going to take a look at a table where everybody has the same expectation, okay? We've got the covered call seller who has bought stock and believes that it's going to go up and he's going to get the capital gain or the premium from the covered call or both, okay? We've got the call buyer because on the other end of that same transaction there has to be a buyer, right?
Sure. You have to have the completion of the transaction.
Right. If you're going to be selling calls, somebody has to be buying calls, okay? And then on the other side, of course, or in between, I should say, the call buyer and the call seller is the market maker, okay? And what we're going to do is we're going to take a look at just kind of a hypothetical situation here so that we can learn the mathematics on a simple level anyway behind what's going on in that table, okay? All right, so we've got the stock at $50,000. I'm sorry, at $50.
Mm-hmm.
And we've got an investor with $100,000, all right? The $50 calls are bidding at $1.80, and they're asking at $2. Now, I know, and you know, Mike, that if we place a limit order, we might be able to get somewhere in the spread, okay? But just for the sake of the example, let's say that we're selling at the bid, buying at the ask, so that our math is really easy, okay? So the covered call seller, using his 100 grand, how many shares can you buy?
Well, that would be 2,000 shares, Kurt, which would allocate the full 100,000.
Right.
And with,
go ahead.
I was just going to say, with 2,000 shares, then we could sell a complement of 20 calls against it. We'd collect 180 times the 20 times 100. So I believe that would bring in, what is it, $3,600?
Yes, that'd bring in $3,600. Now, on the other side of that, let's say we have another retail investor who buys calls, and let's say that he is the same size of a player. You know, he has $100,000 capital to invest, but he doesn't invest all of his capital, okay? He only uses a portion because of the highly leveraged nature of buying a long call.
Mm-hmm.
So what he's going to do is he's going to buy, 18 calls at $2 because the ask price is $2. He's going to buy 18 calls, and he's going to spend $3,600. All right, so now there's no mystery of where that $3,600 comes from. The long call buyer has spent $3,600. The cover call seller has received that $3,600. But there's something here that's not accounted for. So what's going on?
Well, yeah, there's a subtle discrepancy here. We have 2 calls floating out in the ether. We have 20 calls sold and 18 calls bought, so there's still 2 calls that need a fulfillment for requirement.
Right. Okay. So 20 calls have been sold, only 18 have been purchased, so where are the other 2 calls? Well, here's the deal. The market maker gets them. And I'm not going to say that he buys them. He kind of gets them for free. It's a lot like the frequent filler card that I have at the local coffee shop here. If I buy 9 coffees, my 10th one is free. Okay, they give me a 10th coffee for free, and so that's why I go to that shop all the time. Okay, here's the deal: every time this market maker does a transaction, he makes the spread.
Mm-hmm.
He has the wonderful privilege of being able to buy at the bid and sell at the ask. You and I can't do that, but he can, and that's kind of an advantage to him. And what happens is every time 9 calls get sold at that 20-cent spread, he has $1.80 in his pocket and gets to buy at the bid, so he's able to buy one free. Now remember, I said that all 3 players at this table have the same expectation. They all expect that XYZ stock is going to go up. Okay? All right, so just a summary, the cover call writer, CW, sells 20 calls at $1.80. The long call buyer, LC, buys 18 at $2. And the market maker, MM, there, he owns 2. I'm not going to say he buys them because he just kind of owns them. Mm-hmm. he owns 2, and it's a zero cost basis. So let's see what happens. If the stock goes to $55, Mike, everybody's going to win, right?
Well, yes, all 3 are bullish strategies. Mm-hmm.
Yeah, cover call sale is a bullish strategy because the biggest part of the cover call transaction is the ownership of the stock, and you wouldn't own stock unless you're bullish. That'd be just silly. Okay. And then secondly, buying calls is bullish, and owning calls, holding and sitting on calls is also bullish, and so all 3 of them end up doing well. The $50 calls are worth $5 on expiration Friday. And so the cover call writer is going to get called out of his stock, right? I mean, he picked up $1.80 for each of those. Mm-hmm. Is he likely to want to spend $5 per share to hang on to the stock when he could just cash it in? And
well, they could. They could, but most likely they just want to take the assignment. They'll make their 3.6%, and they'll move on to a new position for next month.
Yeah, 3.6% in a month is decent. And if he was to buy if he was to buy to close these calls, it would cost him a pretty penny. It'd cost him more than he took in, and you know, who wants that? Okay, so generally speaking, the cover call writer is going to go ahead and take assignment and keep his $3,600. The long call buyer, well, he's able to liquidate his calls at a $3 profit. Remember, he bought them for $2. Mm-hmm. Today they're worth $5. So he keeps his $3 a contract, or $5,400. So he's a little bit bigger winner, but he's still a winner. And then the market maker, he's also able to liquidate his 2 calls, okay, and $5, and he had a zero cost basis, so he makes $1,000. Now, out of these 3, which is the clear winner?
Well, monetarily, the long call buyer has the most return, the highest monetary return. But the key here is we have to remember the market maker made $1,000 but didn't put anything into the position, didn't put any capital into the position. So percentage-wise, the market maker's return looks infinite. But monetarily, we see that the long call buyer has the highest profit.
Right. If you divide what each person had in the play by what they earned, that's how you get the percent. When you try to divide by 0, you end up with infinity. Mm-hmm. So the market maker actually has kind of an infinite return. But as far as dollars made, it was the long call buyer in this case. Okay. So let's say that everything goes back to where it was. Okay. Everyone wins, so they count their money. Good for them. All right. And now the stock returns to $50, and we see the same situation again with the $50 calls at $1.80 by 2. Okay, the covered call writer sells 20 again, right? He buys stock and then he sells 20 calls. The long call buyer buys 18, and the market maker picks up 2 with no cost basis. But this time the stock goes down.
Mm-hmm.
Mike, if the stock can go up by 10%, which is what we saw in the first play, can it also go down by 10%, like we're seeing in this play?
Oh yeah, I mean, we saw some positions, I won't say 10%, but we saw some stocks drop 4, 5, 6% in the past day or two. You know, it's just a little market hiccup the other day, and we saw some positions drop down about 5 or 6%.
Exactly. Okay, so when that happens, the covered call buyer is going to be able to keep his premium that he took in. Let's see how everybody else does, okay? All right, so the long call buyer loses his entire investment. His investment had been $3,600 to buy, 18 calls at $2. Now they're worth 0. So his entire amount that he invested is gone. The market maker doesn't make anything, but he doesn't really lose anything either, does he?
No, he didn't have anything in there, so he doesn't make a profit this time, but he didn't put anything into the position either.
Right. Yeah, he uses frequent flyer miles, so to speak, to have his long position. So he hasn't actually lost any capital. Okay. What about the covered call writer? He gets to keep his $3,600, doesn't he?
Correct.
Selling those calls.
Mm-hmm.
Yeah. But there is a problem, and that is that he's sitting on 2,000 shares of stock, and that stock is down $5. So really, Mike, if he liquidates, does he have a loss or no?
Well, if you liquidated everything right now, we'd still be at a loss, wouldn't we, Kurt?
Right.
Down 6,400, right?
Exactly. He'd be looking at a loss of $6,400. Okay, and the stock, of course, being down $5 a share, it could continue to go down even more, right?
Correct.
So yeah. So geez. Well, this is just this 2 plays, okay, at the same table. At the same table, 3 players came to play, and they all had the expectation both times. And here's the zero sum, okay? The long call buyer makes $5,400 on his first play, but he loses $3,600, his entire investment, right, on the second play. Is he ahead?
Yeah, he's still positive value of $1,800, Kurt, right?
Yeah, he's still ahead. The market maker made $1,000 on his first play, but he loses nothing on the second play. So is he also still ahead?
Yes.
Okay. And then the covered call writer made $3,600 on his first play, and on the second play he lost a net of $6,400. Remember, he keeps 36 in the second play
for the premium, right?
$1,000 in the stock. So he loses $6,400 in the second play. So Mike, did he make anything?
No, we're behind right now.
Yeah. Okay. So the covered call writer did pick up the $3,600 that the long call buyer lost. Okay. But the long call buyer and the market maker picked up the $6,400 that he lost. Do you see that?
Mm-hmm.
Here's the $3,600 for this gain comes from there, and then the $6,400 for those gains comes from the covered call writer. Okay. So when we talk about it being a zero-sum game, this is where the zero sum comes from. Everybody was right one time, everybody was wrong one time, but everybody but one profited by these 2 plays, and he financed the other 2. That's kind of sobering, isn't it? Okay. The conclusion is that the long call buyer ended up being the savvy pro here. The market maker, of course, is the house, and the covered call player in this case was the patsy. Hey guys, again, don't get the idea that I'm calling anybody a patsy. In fact, I have been the covered call player, right? That's how I got hurt over a decade ago, and decided to find out why. And it wasn't because of the covered call strategy by itself. It wasn't that. It was because I didn't understand structure. And the way that this table was structured, Mike, it was structured so that only 2 of the 3 players could consistently win, right?
And that's true. Now you can have, 2 or 3 cycles of this, Kurt, where, as you mentioned, everyone wins. You could have 2 or 3 rounds of that where everyone makes, the 3% or 4% as the stock moves up. Let's say the stock moves up 4.5 to 5% every 30 days for the next 2 or 3 months. Well, eventually it's going to correct, and that's when everything gets shaken out.
Exactly. In this case, what the winners needed to do was to find someone to agree to take less on the way up and risk more on the way down, and that's kind of what this cover call strategy was. Okay, but more importantly, I wanted to show you this because this is what's responsible for folks losing even more. Okay. In this case, only one retail player was only hoping to make 3.6%, right? That was cover call player.
Sure.
But the other was willing only to risk 3.6%. That was the long call buyer. Now, monetarily, he made more than anybody at the table, right?
Correct.
All right. So does that necessarily mean that buying long calls is a better way to go?
Well, yes and no. And what I mean by that is the long call structure allows you to have a limited risk approach. You know how much you're risking when you buy the long call, and when you enter the long call position, you are leaving your upside open. So if you're bullish on a stock and it does move up 8%, you're going to make more than the covered call trader who's willing to only take 2, 2.5, or 3% return. However, there comes a risk with leverage trading. And that's risking too much, not forcing an ideal size trade, and not properly putting in a correct position size. You can overtrade too easily with these kind of leverage positions, and that can really come back to haunt you.
Right. The thing is that the net between 2 trades for the cover call player was that he lost $2,800, right? He made $3,600 on his first play, and he lost $6,400 on his second play, so he netted $2,800 loss, right? But it doesn't mean that selling a covered call is necessarily a better strategy than buying a long call, because the thing is, if that long call buyer had bought everything, if he had put his entire investment, whether it was $100,000 or whether it was $10,000 or whether he only had $1,000 to trade, if he put it all into his long calls, he would have done very well once, and then the second time he would have cleaned himself completely out.
Yeah, it does come with 100% risk of whatever you invested into the position.
Exactly. Okay, so the lesson to get from this is not covered calls bad. No. And the lesson is also not long calls good. That's not the answer either. What the lesson is structure. What's more important than the actual play itself is the structure of the play. Okay? And what we need is a structure, a position that has strength, and that's where to begin. And then from that position, any move can be advantageous, or at least minimal risk. In fact, Mike, you've even done this, where you've gotten into a very nice position, and then you sold covered calls. Correct?
Yes.
Yeah, and so it's possible to do that. Okay, so here's what I wanted to show. I wanted to show some structure here and make it so that everybody kind of gets there. Okay. In a 12-month period, I love using this example. It's a little dated, okay? It's like 3 years ago. But then again, I like using dated examples. We've got examples we can use from, today, yesterday, right? But I also like to use the dated examples because they show that the principles are timeless. Well, this particular example I love because I did the same thing twice in a 12-month period, okay? Within a 12-month period, I played Altera Technologies twice. The first time I made 12%. Now, I only made 12%, only, quote unquote, made 12%, though the stock went up by 17.3. And this is because I was using a highly protected position. In fact, at a certain point, it's what we call bulletproof. They couldn't go against me, okay? All right. But then the other thing is, the second time that I played Altera, I lost 5.6%. But Mike, I lost 5.6% even though the stock had gone down by over 20%. In fact, if I had stayed in even longer, and the stock went down even further, and it did, I still would have only lost the 5.6%. So is that kind of curious? Do you think that'd be something to show folks?
Yeah, I think that's what they came to see, Kurt.
Okay. All right. So here are the players at the table again. The fellow that sold me the stock, right? The fellow that sold me the put option, all right? The market maker, and of course me. Now we've got 4 players at the table. We're going to discuss who came out ahead and who lost over these 2 plays, okay? So the first play, I picked up, because the shares of stock were trading in about the $30 range, I picked up 500 shares of stock. And at the same time, 5 2011 $29 put options. Now, first of all, that looks a little weird for a married put play, doesn't it? There's 2 things that are different about that than what you would normally see in a married put.
Yes, well, if they've ever read any free information at your broker or at any options education service, you may see that the married put is defined as buying shares of stock, let's say at $27.35, and buying an out-of-the-money put option, a put option that's at a lower strike for a cheaper cost. So we may be looking at the 25 strike for 80 or 90 cents, but only 1 month out in time. So if this is September, I'd look to buy Altera at $27.35 and maybe buy the October 25 put for about 90 cents. Now, why this looks weird, Kurt, is that you're actually buying a put that's several months out in time. It's September, so we've got about 6 months of time out to March 2011, and you're buying a put that's at a higher strike. It's an in-the-money put compared to the current stock price.
Right. Now, here's why this works out. When you first saw this, Mike, by the way, you had a traditional background, traditional training in options and so forth, and you looked at this and said, I see what you're doing. You're trying to keep the risk really, really low, and I did. But I don't see how you're going to make any money with that. Right,
because if we think about this, Kurt, the total cost into the position is $30.85. So if we think about a static break-even, what we're used to with covered calls trading, meaning, hey, I sold the call at, bought the stock at 50, sold a $49 or sold a 47.5 call, or let's say a 50 call, I should say, for $1. Well, my break-even's 49. Anything above that, I make money. When you look at this and say, oh, your cost basis is $30.85, you're not going to make a dime until the stock's trading up to $30.95. That's a pretty significant move, so I don't see how consistently you're going to be able to profit with this.
Right, and that was then. This is now. Of course, since then, you've been able to do some really incredible things, including one time picking up 59% on a position. Another time, a position went down by 75%. I mean, the stock went down by 75%, and you came out of it being long stock. You still came out of it with a 1.8% profit. You know?
Roughly, yeah.
Yeah, some really interesting things can happen when you do it this way. But rather than explaining all the complex math behind it, we'll just go ahead and show how this behaved, okay? Now, first of all, the amount that I spent, $30.85, okay, minus what I'm guaranteed to get back. I'm guaranteed, after all, because I own a $29 put option, that any time over the next 6 months I can liquidate this position for $29 or better, right? So $1.85 is really all that's at risk, or 6%, okay? Now, the first time I played this, it was with 500 shares because the stock was trading around the $30 range, okay? And made 12% in about a 7-week period. Now, oh, by the way, just a real quick aside, Mike, would I pick up 12% if I had played over a 7-week period, if I had played a short call?
No, if you bought the stock and sold the call, you might have made a, excuse me, your regular percentage of maybe 2.5%, 3.5%. You could have dumped more money in the position to roll the call, potentially, but, you know, getting assigned, you would have just made your 3 or 4% return.
Well, let's be generous and say 6%. Is 12% better than 6%?
Yeah, that's more than double, isn't it?
Yeah. Okay. So this is what happened the first time. Now, the second time I got into the same stock, with the same kind of indicators going on and the same, fundamentals, okay? But I was dead wrong, okay? The stock went down in hard. This time, because the stock was in the $50 range, I picked up 300 shares. So it was the same capital both times, if that makes sense, okay? I spent, here this first time, I spent about $15,500. And the second time, I spent about $15,500. I lost 5.6% of that, okay? Even though the stock went down by over 20%, and even if I had held on longer to where it was at 31% or greater, my loss still would have been only 5.6%. So between the two plays, Mike, well, let's talk about it. Can you see the Patsy sitting at this table? All right. In the two plays, one time I make 12%, or the dollar amount was $1,836.55 after commissions. Okay. And in the second play, I lost money. The dollar amount was $956 and change. Okay. So between the two plays, I made nearly $1,000. Even though I was only right half the time, and when I was wrong, I was really, really wrong. Still made money. Well, who's the Patsy sitting at this table? Was it the person that sold the stock? Let's say he sold short here, and he also sold short here. Over the two plays, did he come out ahead or behind?
It would have, the short stock seller would have come out ahead, Kurt. So sure, they might have lost 17% in the first round, but they would have made maybe up to 31% in the second round.
Right. Was it the market maker? Was he the Patsy?
Well, not likely. The market maker had to make money, otherwise there wouldn't be a market there for you guys to trade.
Right. Was I the Patsy?
No, because we see you made profit. You made 12 on the way up and only lost 5.6 on the way down due to proper structure.
Right. Now there was one other individual involved in this transaction, in these two transactions, and it's the fellow that sold me the put. You know, when he sold me these puts, he came out ahead, right?
Correct. Yes, the stock moved up. The put would have expired worthless, and they would have kept the premium.
Right. But when he sold me these puts, he ended up on the hook, didn't he?
Yes, because as the stock fell, the 31%, they would have been forced to buy stock at the higher price, and now they're in a position that's down about 30% or 28% from the original premium they received.
Right. So the person that sold me the puts won the first time, but he ended up on the hook later. And Altera was down very low for very long. And poor fellow. Well, how does this change things for you? Okay, I want to talk about that to our audience. Okay, how does this change things for you? Because you've been looking at getting into stocks, right? And in order to sell covered calls. What about if instead of limiting your upside, you were to limit your downside and leave the upside open? Would that be more attractive? Probably, yeah. In fact, I'm going to go ahead and do a little thing here, and we're going to talk about bulletproofing, okay? Because, Mike, at the beginning, I had only 6% at risk, right? Okay, $1.85 of my $30.85 invested equals 6%, okay? So that's not too much. And again, the whole thought is, geez, Kurt, you're investing an awful lot there. You invested $30.85, and I don't think you can make a dime until Altera makes it from where it is, $27.35, all the way to $30.95. Well, that would be true if the put option actually came down in value dollar for dollar as Altera goes up. But if it's not the case, that's not the case. The put options don't behave exactly that way, do they, Mike, especially when they're far away in time?
No, we don't see a one-to-one decline.
Exactly. Would you be surprised to know that way before this stock ever got to $30.95, I was already guaranteed to make money? We were what we call bulletproof way before hitting $30.85. Okay, and here's why: when the stock goes down, when the stock goes up, the puts come down, right, in price, for the most part.
going to decline, but they're not going to decline one-to-one.
Exactly. Well, here's what happened. Altera went to $29.40, and if you recall, it was a $29 put option that I had bought. Okay. In fact, let me just go back a couple of screens here, and we'll just look at it again. Okay. It's a $29 put option, and the stock had been at $27.35. Now, when the stock went to $29.40, then that means it has gone to where now the put option is out of the money or at the money, right? Okay. So here's the deal. We're well below that break even of 30.85, but it's possible for me to do two things here. Number one, I'm going to take a credit, and number two, I'm going to leave the upside open in case the stock decides to keep going up. The income methods reduce the gap. You see, this is the $30.85 cost basis, and down here is the $29 put option. And so what happens is I can only lose 6%. But when I do the income methods, I make it so that I can lose less. In fact, it's possible to reduce that gap to less than 0. We're going to do that here with the Bulletproof vest. Like what I did, this is the first of our 2 riskless spread trades. What I did was to sell the $29 put and buy the nearer in $30 put. This is March 2011. This is November 2010. Okay, and so by doing that, do I make a credit or a debit?
Well, you're going to take in a credit. You're going to sell to close the put that you own for $252, and you're going to use some of that proceeds to buy a closer input at a lower price. So you're buying the November 30 put at $162. So you're saving 90 cents essentially. You're taking in essentially a 90-cent credit on the position.
Okay, so let me ask you, do I still own the stock?
Yes.
Yes. And do I still have a put option protecting that stock? Yes.
Of course.
Yeah, in fact, it's actually a $1 higher put option. Okay, so this 90-cent credit times 5 contracts, that's $450 in pocket, but what has happened is I've taken and manipulated this put option. Okay, the original stock, the original price for the put option was $3.50, remember?
Correct.
$1.85 of it was this time value, and $1.65 of it was intrinsic value, because the stock was at
$27.35. Yeah.
Right, and it's a $29 put. Okay, so $1.65 intrinsic value, $1.85 extrinsic or time value. Now, in order for this put price to go down, all right, what had to happen to the stock's price?
Well, in order for the put to decline, the stock has to move up, and you own both securities.
Right. So every dollar that's lost out of the intrinsic value is a dollar gained in the stock, right?
Correct.
So is there a net loss for me? I mean, if for every dollar that my stock goes up, my intrinsic value of my put comes down $1, do I lose anything when the stock goes up by a couple of bucks?
No, it's a trade-off, but there's also something else interesting that happens.
Yes, there's another interesting phenomenon, because what happens here is I haven't lost anything when this intrinsic value went away, but I did gain something. You see, the price of that put went from $350, okay, to $252 a contract on the bid side.
Mm-hmm.
Okay, it appears that the value of my put has gone down from $350 to $252, and well, it is the intrinsic portion. The intrinsic portion has gone down, but it goes down as the stock's price goes up, so that's a wash. All right, and so the intrinsic value had been $1.65, and the time value had been $1.85. As the stock's price went up, the intrinsic value came down, so there's no net loss. But the time value, remember, it had been $1.85, and now it's all-time value. It's all-time value, but that pricing is now $252.
Mm-hmm.
So has my time value actually done something kind of interesting here?
Yeah, the time value is actually swelled. When the option went from an in-the-money put to an at-the-money put, you saw an increase in the time value, and you didn't really lose anything on the intrinsic value as we discussed because you gained that back with the stock.
Right. This is what I like to call, I like to say, don't time trades. Trade time. Don't time trades. Trade time. What I'm doing here just before the earnings announcement is I'm going to take this time value that has swollen up, and I'm going to manipulate it. Okay. So I purchased the mirror in put option. We've got the original cost basis for the stock and the put was $30.85, right?
Correct.
Okay, now doing that credit from income method number 3 where I sold the far put and bought the near put, that brings in 90 cents a share, right?
Yeah, so we're going to drop our cost basis down to about $29.95.
Right, and I'm also changing the put option that I have. Now, it is a shorter duration, but I never intended to hold that thing all the way till March anyway. I just bought it far away in time because that's how we do it. That's how we structure our trade. Okay, but I never had the intent to hold out all the way out till March because my time value is going to go to 0, right? I don't want it to go to 0. I'm able to use it right now. I was able to use 252 of it just now. Okay, so here's the deal. Now I've got a cost basis of $29.95 and a guaranteed payout of $30. Okay, so what's my at-risk amount, first of all?
Well, it's strange. The at-risk amount is now negative. You have a negative 5 cents at risk. Well, negative at risk means a positive return. So what we're saying here is that your position is bulletproof to the tune of 5 cents. If the stock dropped to $1 per share tomorrow, you can be long stock and you have this put in place, you'll still make 5 cents even though the stock's down 95%. And you're still guaranteed a profit. But what's interesting about this, Kurt, is that you haven't done anything that would limit your upside. You own stock and you own put that guarantees you a 5 cent profit. But if the stock moves up, continues to move up, you haven't done anything to cap the upside gain.
Right. I just took a 90-cent credit, but I took that 90-cent credit without selling a call. Selling a call would limit my upside. Manipulating this put option does not. And so the end of the story is this. I held that stock through the earnings announcement and experienced a gain of 12%, okay? And when you factor in the cost of, what do you call it, of commissions, both buying the stock, buying the original put, manipulating the puts, and then finally selling the stock, it takes my 12% gain down to 11.9% gain. So was it still worth it?
I think so.
Yeah. Okay, so that's that play there. Okay, this is done just before an earnings announcement. I don't know if you all out there have the same thought, but man, I used to either just exit a position before going into an earnings announcement, or I'd bite my fingernails down to the second knuckle. Okay, but how would you like to have none of the butterflies of an earnings announcement, none of the fears, but all of the anticipation and excitement of, hey, maybe this earnings announcement is going to shoot us through the roof. Okay, kind of cool. So that's the first riskless spread trade I wanted to show. And at this point, I'm going to go ahead and ask everybody, think about what I just showed you. Now, before we even talked about bulletproofing, okay, bulletproofing where there's 0% at risk. Do you remember how we started this position with 6% risk?
Correct.
Yeah. Now, Mike, if the stock had just, like I bought in and it goes down immediately, I wouldn't be able to do that income method number 3 play, would I?
Not necessarily, no.
Yeah, I'd probably be looking at, well, maybe the 6% loss or 5.6% loss. I might be looking at that. All right, but let's think about it. If every play that you did last year, I'm talking to the audience now, if every play that you did last year, the losing ones were scaled down from whatever they were to 6% or less, would it have been a better year? Would it have been a better year if your losing plays from last year were scaled down from whatever they were to 6% or less, okay? And let's leave that up there because I want a full participation in this particular category, okay? Got 49 of you here in the room with us. Thanks for being here, by the way. And I'm just going to ask, hey, guys, if you had a time machine and you could go back and say, hey, dude, do this instead, would you? Would you want to limit your risk to single digits, 6% or less, in all of your losing trades last year, but still leave the upside open? That's the other side of it, leaving the upside open. Okay, let me leave that up for another 3 seconds, 2 seconds, 1 second, and close. Okay. Mike, before I address the 93% that said yes, let me talk to the 7% that said no. The 7% that said no, that wouldn't have changed my trading. Why do you figure they would have said that?
Well, they might already be limiting their risk to less than 6%, doing swing trading, day trading, or some, quick motions, day trading quick motions. What may be a risk with that, or not a risk, but what may also come into play with that is that if they're closing their positions quickly so they never take more than, let's say, a 3 or 4% loss or even a 1 or 2% loss in day trading, they're probably also getting out quickly and capping their gains, so they might only be making 1 or 2 or 3% on the upside as well.
Right. Okay. Let's talk now about the other 93%. Okay. Let's start at the top there, the second line.
Okay, well, 20% of our audience said they might have lost, but would have lost much less. Well, that would put them in a much better place, wouldn't it? We would have had more capital that we started off with to continue to trade. Next, we have investors who lost last year, but would have won if they had done that. Is that a game changer, Kurt?
Absolutely. Okay. I mean, if you're going from the place of, geez, I lost last year, and changing places, changing categories into, hey, I won last year, that's wonderful. Okay. How many percent said that?
That was 20%. So they lost last year, but they would have won had they done it this year.
And what's our winner for the day here?
Well, the winner is we had 53% of our audience say that they did well last year, but they would have done even better had they applied that technique.
Well, isn't that what I said at the very beginning? I said we had an unusually large number of people that were doing well already, right? An unusually large number of people doing well. I think it was like 7% so that they were taking names, and like 58% saying that they were making money, that they were ahead of the game. And we never see that.
Right.
We never do see that. But in this particular case, we are looking at more than half of the room saying, geez, I did okay, but you know what? I would have done better if I'd have known that. Well, you know what the good news is? The good news is that you've got the rest of your career. You've got the rest of your life as a trader to go ahead and, I mean, if I ask you the same question a year from today, Mike, the answer could be, yes, I'm very excited with my trading results.
Right.
Very good. Okay, are we back on my screen?
Yes.
Okay, so this bulletproofing notion, okay, taking the risk from low risk and making it no risk, this is what we call bulletproofing. And you can't always do that, but it is commonplace, all right, where you start out with low risk and then you can get to a place where you have no risk and still have unlimited upside. Mike, you're doing that right now with Johnson & Johnson.
Correct.
And do you have any other bulletproof positions or positions that may become bulletproof soon?
Let's see. Yeah, the Dunkin' Donuts position is probably going to be bulletproof with the next adjustment, I believe. That's the income method number 7 one, a little bit more advanced, but hey, it's a lot of fun. In addition to that, we do have some lowered risk on, LGF and ATI. I don't think they're going to be bulletproof because something that's described in the blueprint, we're doing, I don't want to say something a little bit different, but rather than trying to, I could bulletproof ATI with an income method number 4 trade right now, but I'm not because I'm being greedy. But I'm being greedy with the knowledge that I can't lose more than 2% on the position if the stock corrects.
Isn't that something? 2% is your risk right now, and rather than doing a bulletproofing move, you're just going to sit because.
Well, I'm doing income methods to increase the upside, which aren't bulletproofing the position as I could with income method number 4. So we're just knocking off premium at a time, going on the greedy side on the upside, but still keeping our risk. We're at 2% risk or so, 2.2, 2.3% risk or so. So instead of bulletproofing it right now, I'm just continuing to do that.
Gotcha. Are you doing one of the one of the riskless spread trades?
I did do 6 recently, but right now I'm just using, honestly, income method number 1 because it has a higher premium and the stock is just floating in a range right now, a couple strikes above where our protection is, and we've already reduced it down to 2%. So instead of bulletproofing it, I'm just taking premium and then probably going to close it within the next 30 to 40 days.
Cool. Very cool. Well, folks, we'll get back to this, and I'm going to share with you another riskless spread trade, okay? But first, I'd just like to know what you think of that, okay? What do you think of spread trades that take income, okay, like the income method number 3 plated, risk nothing if they go against, and still leave the upside open? You might actually say, Mike, some folks might actually say, hey, that wasn't a spread trade, because you simultaneously bought and sold puts, right? But
yeah, we closed the one that we owned, and we bought to open a new one at a different expiration and a different strike.
Right, yeah. So some folks might say, hey, that's not purely a spread trade. Well, I think of it as a spread trade because if I had done that, I would, if I didn't already own the stock, didn't already own the first put, but if I just sold the far and bought the near, could I do that? I'm allowed to do that, right? If I've got the right clearance in my trading account, I could do that.
Yes. Mm-hmm.
Okay, but the thing is, that would come along with a lot of risk. All right. What we're going to show next is I'm going to show a spread trade, an actual spread trade where you open 2 trades at the same time. You sell to open and you buy to open at the exact same time, but it is riskless and it generates credit. You're going to be kind of impressed, I think, with this. So let me talk, or let me address this real quick here, Mike. Okay, 57% like those spread trades that take income, risk nothing if they go against, and still leave the upside open. 57%. That beats the shiitake mushrooms out of covered calls. You bet it does, because it leaves the upside open. Okay. 21% want to know if they can do what I just showed in an IRA. Mike, can they?
Yes, actually, I'm trading most of my married put trades right now in a restricted account at Fidelity, where all I'm allowed to do is buy stock, sell covered calls, buy calls, and buy puts. That allows me to do everything except for the full income method number 5 trade, but I can still do an income method number 5 against it. I could apply to do income method number 7, which I did. That wasn't too bad.
Yeah, you did that.
That's right. And then I can even do income method number 11, one of the newer income methods in a certain range. And so I can't do income method number 8, Kurt, and I think that's it right now. Yes, that's it.
How about that? How about that? Well, 21% say, can I do that in my IRA? 36% say, whoa, I didn't know you could do that. You got any more? Yeah, we got 10 more. I'm going to show one of them right now. Okay, and then we'll go ahead and close today's class. What we're going to do is we're going to steal the market maker's edge, because I hate that market maker. I say that knowing that full well that my Australian friend, I've got a friend in Australia that is a market maker over there. And I think he's wonderful. His name's Shaquille. I won't give you his last name for privacy reasons. But I know some market makers, and the thing is, I hate that those guys get to bite the bid and sell at the ask. Not cool. Anyway, this amount at risk, okay, if we're buying shares of stock and also buying in the money far away in time put options, gives us the total invested minus our guaranteed investment. In this case, Mike, $470 per share is at risk, or around 6% again. Okay. Mm-hmm. Now, let's remember that this is scalable. Okay, you could do 100 shares, risking $470 apiece, or you could do 200 shares, risking $470 apiece, and so on. No matter how big a fish you are, Mike, if I was to get 200 shares, risking $470 each, would that be 13.4% at risk, or would it still be the 6.7?
No, your monetary risk does go up to $940, Kurt, but that's still the same percentage of the higher investment.
Right, it's the same percentage of whatever amount that I put in. So, Mike, this is an actual trade of mine from a few years back. This is about 14 grand into the position, all right? Mm-hmm. But only 940 of it is at risk, so that's 6.7%. 200 shares, 2 puts, 6.7% at risk, okay? So that was the profit-loss position, okay? And now we're going to rob the market maker of his edge. You know what I hate about that market maker? He's got that bid-ask spread covered, and I don't, okay? It bugs me, okay? So here's what we're going to do. I'm going to sit at the table with the other players, okay? And at this table, we're trading April calls. Now, the April 6750s are bidding at 95, and they're asking at 105, okay? And the April 70s are bidding at 35, and they're asking at 45. Now, Mike, if I was to sell the April 6750s, okay, and simultaneously buy the April 70s, what would we call that technique, or what would we call that play?
Well, that would be a bear call credit spread, Kurt.
Bear call credit spread, okay? And what's happening is we're picking up a credit. Now, if I was to do that twice, you know, sell 2 calls and buy 2 calls, okay? I generate 50 cents here, right?
That's right. The difference between the sell option and the buy option is a 50-cent credit. And if you do 2 contracts, you take in, 50 cents times 2 times 100, you take in $100 net premium.
Right. Now, that $100 is showing up as a negative here because that is the cost. The cost is negative. In other words, I'm getting paid to put this on.
Right.
But there's a dark side. What's the dark side that's involved in this whole thing?
Well, anytime you trade any options, you have to be aware of your rights and your obligations. You sold a call at 67.5, which means you're, or 2, okay. 2 calls at 67.5, which means you're obligated to deliver shares of stock at 67.50 if the stock is trading above that price. However, you also bought 270 calls, so that gives you the right to buy shares of stock at 70 if the stock gaps up to $75, $80, $85. The trade-off here is that that's a difference of $2.50 between the strikes, or for 2 contracts, it's a difference of $500. You may be risking $500 to make $100.
Right. Okay, so that's a net risk then of $400 in this play that brings in $100 on the front end. Okay, so if you recall, my radioactive profit machine, where I bought the stock and bought the put, 200 shares of stock, 2 puts. Okay, it has $940 at risk. Do you remember that from a few slides back?
Indeed.
Okay, and then this other play here. Oh, and that duration is till August. Okay, and then this other play here is just until April, but it has $400 risk. Now, what would you say is my combined risk if I'm doing both of these plays? I'm doing the play where I buy the stock and the put, and if the stock goes down, I could possibly lose $940. Okay, and I'm also doing this play where I'm selling the low calls and buying the high calls, and if the stock goes up, I could lose up to $400. So looking at the risk of these 2 plays, what's my total at-risk amount?
Well, if we just add column A and column B, we'd say it's $1,340. But that's not the case. We got to take everything into account of what we own, what we've obligated ourselves to do, what we're protected against, and what is the total profile.
That's right. Okay. Let's take a look at it graphically using the Power Options software. The net risk is not 1340. That's most folks' knee-jerk reaction. They look at the 940 at risk in the married put and the 400 risk in the bear call spread, and they'd say, hey, it's 1340. But that's not how it is. You see, the $100 credit that's received from doing the spreads goes to reduce the cost basis of the stock, right?
Correct.
And therefore, it reduces the risk in that play by $100. Okay, so now instead of 940 at risk, I have 840 at risk. On the other hand, owning the stock in the first place takes away all the risk of the bear call spread. Well, doesn't it? I mean, if I'm called upon to deliver the shares of stock, I don't have to go out on the open market and buy those shares. I don't have to use my upper strike calls to buy those shares. I own those shares. So is there any risk at all to me to do the bear call spread?
No, that risk we talked about being obligated to deliver shares of stock at 67.50 is negated by the fact that you're in a proper structure of owning a protected stock position.
Exactly. Here's what's exciting, okay? Because the bear call spread itself is losing money from 67.50 to 70. Because of that, all right, I've got this little peak and this little valley, but even the bottom part of the valley is above the break-even line, isn't it?
Correct, yes. Even if the stock gaps up, we're not giving, well, we're giving something back, but the gain in the stock is more than countering what we're going to lose on the spread.
Right. This stock more than covers my loss. I can't lose without winning. And, hey, what if the stock goes up above 70, which guess what? It did. This green line shows the cost of the stock at that time that I took this little snapshot. It was at $70.63. Well, what's happening now?
Well, you're taking a loss on the spread, but you're still gaining on the stock position. You still have an infinite, you have an infinite upside on the position.
Yeah. In fact, what's happening is if I get assigned here, if my stock gets bought, okay, here at this price, I can still sell my put because it's going to have some value to it. But here are two calls that I've been paid to own. I've been paid to own these long calls. You see, the short calls get taken care of by delivering the stock. The long calls I haven't closed. They continue to roll up, okay? And so I still have an infinite upside potential if the stock goes up. Isn't that something? By the way, the put option protecting this stock and keeping this break-even line so very shallow, okay? That put option is clear out until August, but these calls expire in April. So do I have time where I can do this more than once?
Absolutely.
Yeah. Instead of a 6.7% risk, now I have a 6.1% risk. I still have infinite upside. Instead of a 940 risk in my married put, I have an 840 risk in my married put. Okay, and no risk to the bear call spread. So this is why I say that we're stealing the edge from the market maker. He buys at the bid and sells at the ask. Remember that? We're for example, the April 70 calls were bidding at 45 cents, and they're asking it at 55 cents.
Right.
Okay. Well, did we just take a 50-cent edge for ourselves?
Yes.
Yeah. By doing that bear call spread, we just reduced the cost basis of our stock by 50 cents. And if it goes against us, well, we make money. And if it doesn't go against us, well, we get to keep the 50 cents. And we can do it again. Okay? So we get to grab that edge. That edge of the market maker is usually 10 cents wide. We just grabbed ourselves a 50-cent edge, and we can do it again. So that's kind of exciting, I think. All right. Mike, do we have any questions coming in?
A couple basic ones, and we got to wrap up because we're about 20 minutes past. One question that came in was just, can you do this technique with ETFs such as DIA, SPY, and QQQ? Yeah, Kurt's had success with those. You know, if you get the blueprint, you'll be able to see some of the concepts and discussion about that. You know, the ETFs tend to move a little bit slower, so you don't maybe expect to see. That's a trade-off is what I'm trying to get at, Kurt. You don't see as many opportunities maybe to do the different income methods with as good a premium on the ETFs as they're moving more slowly. But that also gives us an advantage that you've done, and you show in your DIA example, you can actually buy an insurance policy that's almost 2 years out in time or more and still only have a 4 or 5% risk due to the volatility and the nature of the options on the different ETFs. ETFs also give us another advantage that if we feel there's a correction coming up, I'll give a little bit of something away for free here that our Fusion subscribers are seeing. If you think that maybe a market correction is coming up or that we might be in a bearish mode, you can trade a married put, a radioactive profit machine on an inverse ETF. And so as the market falls, well, your ETF goes up and you're treating it as a regular radioactive profit machine without having to think backwards or do anything in reverse, without trying to play the bearish market. So it's really unique, and we've got one of those open right now that our Fusion members are following. Another question that came in was from Scott. Scott said he only has a small account right now of about $5,000. Is that enough? Well, Kurt opened his first married put trade or radioactive trade about 10 years ago with $2,500 in his account. And that was just because, essentially, Kurt, what you had left after the covered call debacle and some other events that we don't want to talk about. But you were able to open the married put with $2,500. 5.5 years ago, when I first started trading radioactively, I allocated about, I think it was about $6,000, maybe $6,500 to trade radioactively, and I opened a few positions in my price range between about $15 to $25, and had 2 or 3 positions open. But in general, if you want to trade multiple positions, you want to look for larger price stocks, yeah, you might want a higher account, but you could start right now with maybe 1 or 2 trades on lower price stocks in a proper protected position, with that allocation of $5,000. And I got to admit, I'm going to sound like an advertisement here, but I'd rather see you do that than take your $5,000 and start trading spread trades right now or trading covered call positions.
Right. The big thing about trading radioactively is that it addresses risk first. And the way that we do that, of course, is by purchasing that put option, but then also having as many as 11 different ways to take money out of that position or change the risk in it to more advantageous, or both, usually both. And yeah, I can't imagine trading and not doing it with the radioactive principles, limiting the downside potential, but unlimiting the upside.
Mm-hmm.
It's just a more common sense way to go. And Mike, I've been putting up little billboards here about the blueprint and the home study kit. I wanted to draw attention to one thing, and then we should probably go ahead and give the bonus link and let everybody go. The thing that I wanted to draw your attention to is our guarantee. The guarantee has been in place since I started distributing this idea. Okay, back in 2002, when I first began selling the blueprint, we only had 4 income methods. Didn't have all 11 that we do today. We just had the first 4, and I would only teach income methods that I had successfully used and used with people looking over my shoulder. But ever since then, what I've done is offer the blueprint with a 100% money-back guarantee. That means that if you pick that up and you're not able to see where you either save or make more money than the blueprint costs you, send her back. Send her back. We believe in it that much. I had one fellow, this is crazy, Mike, I had one fellow say, hey, if you're doing so well with your trading, why don't you just do that instead of... That's kind of silly, isn't it? I mean, why not do both? I mean, if I'm doing well with my trading and I can teach others, why not do both? There's really no good reason. And I've got to do something with my time, Mike. I mean, geez, you don't spend all day babysitting your positions, do you?
Oh, no, I spend about an hour or 30 minutes in the morning and then maybe about another 30, 25 minutes in the afternoon in the market close. Sometimes I'll look at it intraday, but in general, with these types of positions, I'll be honest with you, it's almost the opposite of day trading.
Right.
And so that gives me, and realistically, this is one of the reasons why, it was so easy for me to switch to radioactive trading 5.5 years ago when you showed us the techniques, because I was actually hurting myself trying to keep up with spread trades and, long options, long straddles, long strangles, there's long calls and long puts, credit spreads, calendar spreads, and even covered calls, because my job during the day is not to watch my trades. My job during the day is to handle coaching sessions, education, host webinars, answer email, answer phone calls at Power Options and at Radioactive Trading. So I don't have the time to really spend a lot of time looking at my trades without losing money. And I think most of our attendees are in the same boat. A lot of our attendees we know are a lot of our customers we know are retiring or getting ready to retire. It's not how you want to spend your retirement watching advanced credit spread trades, iron condors and iron butterflies for 5.5 to 6 hours per day just to make sure you don't take more than a 10 or 15% loss. Is that really how you want to spend your time?
I can't imagine. Yeah, I'm much more happy setting it and just about forgetting it. So that's the deal. Folks, there's a 100% money-back guarantee on the blueprint and also on the home study kits. Also, for those of you that already own the blueprint and would like to upgrade, we are offering for a very short time we're offering that you can upgrade with that bundled price. The bundled price, of course, is a 35% discount. Okay, there's been no better deal. There's not going to be a better price. Okay, so I'm going to recommend that you, if you've been on the fence, that you pick up and do it. And Mike, I'm going to scroll through a couple of these things. Do we have any final questions? I'm going to scroll through a few testimonials from the last 5 years.
No, I've got a discussion with Al going because he wanted us to know what he can do about updates to the blueprint. So I'll talk to Al after sometime later this afternoon after the webinar, and I think that's where we've got.
Very cool. All righty. Well, Mike, it's been a pleasure as it always is.
Hold on. Yeah, hold on one second before we cut off here. Hold on one second. I'm going to be mean to Kurt, everyone, so just hold on for 1 second.
Doing it, Michael.
Okay, Mary asks, Mary asked, can you please re-show the deal? Well, Mary, what we're showing up here, I sent everyone a link through the chat window. Go to radioactivetrading.com/iridium to see the current bonus offers that we're offering for the home study kit and for the blueprint. And of course, what's
not everybody gets to see this, do they, Mike? I mean, if you go to radioactivetrading.com only, you won't see these cool bonuses, right?
Right. Oh, and Casey asked, do I need to buy both to trade? No, Casey, you don't need both the home study kit and the blueprint. You know, it's just that the blueprint contains everything that you need to trade radioactively, but it's presented in a text format in a 3-ring binder, hard copy. Okay? Now, if you feel that you learn better through a different sort of media application, with the home study kit, we still send you the blueprint, but we're going to give you the 6 CDs as well, the Mastery Series CDs that Kurt put together, which go into the different income methods and some examples of the income methods, but in a video format like we did today, that you can watch at your own time and, of course, at your own preference. So if you feel that you learn a little bit better through that method, through that technique, you may want to pick up the home study kit. But as Kurt mentioned, if you do decide to pick up the blueprint today, but then later on you want to upgrade, we've got a special offer now where you can upgrade just for the difference, the $260.
Each of those CDs are $89 a piece. So with 5 CDs, that ends up being $495. All right, but it's just $260. That's the difference between the blueprint and the home study kit. It's just $260 if you already own the blueprint now and you want to upgrade to the home study kit. Some folks do without it. Some folks just say, hey, you know, everything that I need is here, you know, in the blueprints, and if you learn that way best, it's the best way to go. But we send you the blueprint for reference and also the CDs when it's the home study kits. Okay, so I'd recommend you pick up one or the other, and both, of course, still have that 100% money-back guarantee.
There you go.
And yeah, we're confident that you'll save or make more than what you spend. And if you don't, you should call us on it. Send it back. So, very cool.
All right.
I guess that's it, Mike. Why don't I go ahead and wind things up, and we'll see you on Tuesday?
Yes, that's right. Next Tuesday, folks, we'll be back. Yeah. When is next? I'm sorry, my brain is fried, Kurt. It's the expiration week. You know how I get. Yeah, so definitely next week, next Tuesday. And, yeah, the 19th and the 21st, and the following week we'll still probably be here Tuesday the 26th, perhaps, but naturally we won't be here on the 28th.
Right, for Thanksgiving.
Very
good. Okay. Well, folks, thanks for coming. Mike, thank you, and we'll see everybody out there. Happy trading, and bye for now.
All right. Take care, everyone. We'll talk soon.